If you have filed taxes in Canada for the past 10 years, CRA has an amendment window open right now, and you have never received a letter telling you to use it. She kept everything. Dental bills going back 7 years. The little plastic pharmacy bags with the sticker still stuck to the side of the prescription eye drop bottle. Hearing aid battery packs, still in their cardboard sleeves. Carol, 68, retired librarian, widowed 3 years ago, kept every single receipt in a shoebox under the bathroom sink because a librarian saves things. Because somewhere in the back of her mind, she believed that someday they might matter. Nobody ever told her they already did. Every April, Carol drives to the same H&R Block location she has used for 9 years. She hands over her OAS statement, her CPP slip, her small pension documents. The preparer enters the numbers, prints the return. Carol signs. They file. She gets a small refund most years, sometimes nothing. She drives home. That is the whole system. That is all she knows of it. What she does not know, what nobody has ever told her, is that for 9 of those years, she has been leaving money on the table. Not a little money. Money that, for just 3 of those years, adds up to more than $4,000. For most of your working life, you didn't have to think about tax credits. An employer handled your source deductions. A T4 appeared in January. You filed, maybe with help, maybe on your own, and the system confirmed you'd done it. You didn't run the system. It ran itself. That ends the day you retire, not gradually, all at once. CRA doesn't send a letter explaining what changes. Your preparer doesn't hand you a list of what you're now entitled to claim. The whole structure that managed your tax life for 30 or 40 years just stops and a new set of rules begins. Rules the system assumes you already know. Carol didn't know. Most people don't. Here's what I want you to understand before anything else. The window to go back and fix, this is not 3 years. You may have heard 3 years. That figure is wrong for most credits. It applies only to a specific pension-splitting election, not to general tax adjustments. The actual window for most Canadians is 10 years. A request filed in 2026 can reach back to the 2016 tax year. Carol has been filing for 9 years at H&R Block. 9 years of potential adjustments are still reachable. That shoebox under the bathroom sink is not sentimental clutter. It is documentation. By the end of this video, Carol is going to know exactly what to do with that stack. And so are you. I'm a CPA. I file final tax returns for Canadian retirees. I've sat across from hundreds of people who did everything right and watched them lose money to rules nobody explained to them. That's the only reason this channel exists. I should say clearly, this is general information, not tax or financial advice for your specific situation. For your own numbers, you need a planner or an accountant who can look at your full picture. What I can tell you is how this amendment window works, where it does the most damage, and what the retirees I've sat with most wish they had understood 10 years earlier. Carol's income is straightforward. OAS, CPP, a small pension from the municipality where she worked. Combined, she brings in roughly $17,400 a year, well below the threshold that would affect her GIS eligibility. Well below anything that would trigger a clawback on the credits she should have been claiming all along. There are 2 credits she has missed every single year. The first is the age amount. The age amount is a federal non-refundable tax credit available to any Canadian who turns 65 by December 31st of the tax year, provided their net income, that is, line 23,600 of their return falls below the clawback threshold. For 2025, the maximum credit base is $9,028, and the federal credit on that amount is $1,354. The clawback starts at $45,522 of net income. Carol earns $17,400. She is not within 100 kilometers of that clawback. She has been entitled to the full age amount every year since she turned 65, and it has never appeared on her return. 3 years of that credit, 2022, 2023, 2024, adds up to roughly $3,762 in recovered federal tax. Not a deduction from income. Actual tax she overpaid returned to her. The second credit is the medical expense claim, and this is where the shoebox stops being a metaphor. At Carol's income level, the threshold she must clear before her medical expenses become claimable is 3% of her net income. 3% of $17,400 is $523. Every dollar she spent on eligible medical expenses above $523 in a given year is claimable at 15% federal. Dental work, prescription eye drops, hearing aid batteries, yes, hearing aid batteries qualify. Carol has been spending an estimated $2,800 a year on these items and claiming none of it. On $2,800 of expenses, she clears the $523 threshold with $2,277 of claimable amounts. 15% of that is roughly $341 per year in recovered federal tax. Over 3 years, that is just over $1,000 back. Add the age amount recovery and the medical recovery together, and Carol is looking at approximately $4,600, and that is the conservative figure, deliberately rounded down to account for year-to-year variation. The full calculation across 3 years runs slightly higher. She drove past that money 9 times to the same H&R Block, handed over her slips, signed the return, drove home. Now I want to spend a moment on the part that almost nobody talks about, because it is the hidden trap that makes a bad situation considerably worse. The trap is not that Carol missed the credits. The trap is what happens to that money while she is missing it. Carol is 68. She is widowed. Her income is $17,400 a year. She is not poor by any legal definition. She owns her home. She is managing, but $4,600 represents more than 3 months of her total income. And while that money sat unclaimed in CRA's system, Carol was making spending decisions based on a household budget that was wrong. Not wrong because she miscounted. Wrong because the credits she was entitled to were never applied. Here's where it gets worse. Carol's net income, as filed, is slightly higher than it would have been if her returns had been done correctly each year. Net income line 23,600 is the number CRA uses to determine her eligibility and the size of certain income-tested benefits. The age amount itself begins to phase out above $45,522. So at Carol's income, that is not in play. But for a retiree, even a few $1,000s above Carol's income level, an incorrectly filed return can ripple outward. Benefits calculated on net income, including GIS, can be affected by the figure on that line. Carol's GIS position is secure because her income is low enough that the misclaim didn't shift her into a different payment bracket. But for a retiree sitting within a few $1,000s of the GIS income threshold, which for a single senior sits at $22,512 per year, an unclaimed deduction could be the difference between receiving GIS and receiving nothing. That retiree has been losing not just the tax credit, but an income-tested benefit on top of it. And unlike a tax credit, a missed GIS benefit does not get retroactively corrected when you file an amendment. The amendment fixes your tax return. It does not recover GIS payments you should have received in prior years. The amendment window is 10 years. GIS is retroactive only to 11 months at most, under a late application. Those two windows do not line up, which means for some retirees, the damage from a missed medical claim or an unclaimed age amount is not $4,600. It is $4,600 plus years of reduced benefit income that cannot be recovered. That is the trap nobody talks about. File the amendment, yes, but also get the income picture correct going forward because the GIS error is permanent in a way the tax error is not. Carol's numbers are clean. But if you are watching this and your income sits anywhere near $22,512 a year, you need to know that what looks like a missed tax credit may also be a missed benefits question. Now let's talk about what Carol does with the shoebox. The form is a T1 adjustment request, T1-ADJ. CRA also calls this process Change My Return when you do it through CRA My Account Online. The Refile service, which works through tax software, covers returns from 2021 forward. If Carol is comfortable online, Change My Return is the fastest path. CRA's stated processing time for that method is 2 weeks. If she prefers paper, she mails a completed T1-ADJ for each year she's amending, and the processing time is 8 weeks. She does not need her preparer. She does not need to pay anyone. She fills in the tax year, the line number she is adjusting. Line 30,100 for the age amount. Line 33,099 for medical expenses states the corrected amount, explains briefly why, and attaches copies of her receipts. She can do all 3 years in a single sitting at this table. There is one thing Carol should not do. Wait. The 10-year window is a hard backstop, and CRA does not grant extensions. A 2026 request can reach 2016. A 2027 request will lose 2016 forever. Every year she waits, one more year falls off the back of the window. The second thing Carol should know is that she should use the longest eligible period she can document. She does not have to file all 10 years if she only has 3 years of receipts. But whatever she can support with documentation bank statements, pharmacy printouts, dental office records she should claim. Pharmacies typically keep purchase records going back 5 to 7 years and will reprint them on request. Dental offices keep records longer. Carol's receipts are already organized. She is ahead. The third thing is the correction that almost nobody makes, but that matters for exactly Carol's situation. If her returns from prior years did not include the age amount at all, the adjustment is not just worth filing for the tax recovery. The corrected return becomes the accurate historical record of her income and credits. That matters if she ever applies for income-tested support, if her estate is ever administered, if she ever needs to demonstrate income history to a benefits program. She kept every receipt because she thought someday they might matter. She was right. They already did, and now they will. So what can you actually do this week? There are 3 things, and the order matters. 1. Pull your notices of assessment from the past 3 years. They are in your CRA My Account, under Tax Returns. If you don't have My Account, call CRA at 1-800-959-8281 and ask for your notice of assessment history to be confirmed. Look at line 30100. If it shows 0 and you were 65 or older in that year, you have an age amount claim to file. That line should not be 0. 2. Call your pharmacy and your dentist this week, not next month, this week, and ask for a printed summary of your eligible medical expenses for 2022, 2023, and 2024. Tell them you are filing a tax adjustment. Most pharmacies can produce that print out in minutes. Most dental offices can email a statement same day. You do not need original receipts for every item if you have the professional records. 3. Go to canada.ca and search Change My Return. Log in to CRA My Account. For each year you are adjusting, navigate to the return, select Change My Return, update line 30,100 with the age amount figure for that year, update line 33,099 with your net medical expenses for that year, and attach your documentation. If you are not comfortable online, download Form T1-ADJ from canada.ca. Complete one per year and mail them with copies of your receipts to your tax center. Online processing takes approximately 2 weeks. Mail takes approximately 8. Either way, start this week. Benefit amounts like OAS and GIS are updated by the government every few months. If a number looks different from what you're seeing on canada.ca, drop a comment and I'll pin the update. For Carol, that window is already open. She sorted her receipts, called her pharmacy, and logged into CRA My Account the same evening she found this video. 3 T1 adjustments, 3 years of age amount, 3 years of medical expenses, approximately $4,600 coming back to her, processed within 2 weeks, and a corrected income record that accurately reflects what she was entitled to all along. She will not recover the years before that, but she will not lose another one. For you, if you are watching this before December 31st of the current year, your most recent complete tax year is still well inside the 10-year window. The 2016 tax year is reachable through a 2026 filing. Every year you wait, 1 year drops off the back. The window does not announce itself when it closes. It simply closes. The thread running through everything in this video is simple. CRA does not send you a letter when you are owed money you have to know to ask, and the window to ask is 10 years, not 3. I'll say it again. This video is general information, not advice for your situation. For that, you need someone looking at your actual numbers. But everything I've described today is accurate and it matters. If this was useful, I'd be grateful if you shared it with a recently retired friend who files their own return and has never heard of the T1-ADJ. Because the people who most need to see it are the ones least likely to go.